It's time to put the spotlight on mutual funds. It's time for MF Corner, and today we talk about a fund that gives you exposure to equity, debt and gold, and may sound like a perfect mix for your portfolio. But do these gold hybrid funds really add value to your kitty? Dhirendra Kumar, CEO of Value Research, joins in with a perspective. As always, afternoon, Dhirendra. Gold hybrid funds invest in equity, debt and gold. If you look at the performance of the last year or so, these funds have performed better than balanced fund as well as asset allocation funds. What drives their performance?
Primarily, anything to do with gold over the past 1 year, despite the upheavals, even in gold prices, it has been able to provide the dash of, the gold touch. And, if you look at the composition, they are dominantly, in most cases, they are dominantly a fixed income fund, which has been able to generate a modest return. Gold, despite its turbulence, is in the positive territory, and very small allocation to equity, and they have the flexibility to be in equity or in a sizable way or in a very nominal way, depending on the market outlook. So they have kept away from that, and that has led to this relatively impressive return in an otherwise very hostile climate.
Dhirendra, so would you recommend these funds to investors, and do they provide meaningful diversification?
No, I would not suggest investors to be in these, because one is that it's a meaningless diversification. I don't know how gold fits into that. The reason why one should have gold is either one is accumulating for the long run, or one is taking an opportunistic bet. And in this kind of format where the fund manager is taking a call, you don't know whether he is in gold or out of it, or his outlook. So that's one reason. The other is that one is anyway exposed to the gold price risk, which I think at today's point is substantial, even though investors are not disappointed so far.
Let's also take in some viewer queries. The first query is from SN Mohapatra. He plans to simplify his mutual fund portfolio. He wants to know if he should redeem or switch from funds where SIP has stopped to funds where SIP is still continuing, and is the 1% exit load applicable on redeeming funds as well?
1% exit load is applicable on any fund, any installment of your SIP which has not been, which is not 365-day old. So that is a simple rule. So all those installments made within, all those SIP investments made in the past 12 months will be, the 1% exit load will be applicable. And the reason why one should exit these funds should be primarily their sustained underperformance. If you are getting disappointed by the market, and you are otherwise in very impressive funds, I don't think that is good enough reason. Investing in equity should be for a defined time period, and it should not necessarily be 1 or 2 years.